Have you ever wondered how central banks quietly steer the economic ship, especially when it comes to influencing interest rates and the overall money supply in an economy? Central banks buy government securities primarily to implement monetary policy, a crucial function for managing liquidity in the financial system and influencing interest rates, ultimately impacting the money supply. This action helps them achieve their mandates, such as maintaining price stability and fostering maximum employment. The core mechanism at play is often referred to as open market operations, which is the purchase and sale of government securities in the open market. When a central bank buys government bonds from commercial banks, it pays for them by adding reserves to the bank's accounts. This injection of reserves increases the amount of money banks have available to lend. With more reserves in the banking system, the cost for banks to borrow from each other, like the federal funds rate in the United States, tends to fall. Lower short-term interest rates then influence other interest rates throughout the economy, making borrowing cheaper for businesses and consumers, which can stimulate investment and spending. This means that these actions directly affect the cost of borrowing for businesses and consumers alike. When borrowing becomes more affordable, it can encourage companies to expand and hire more people, and it can motivate individuals to make larger purchases like homes or cars. Essentially, it is how central banks manage the economic flow, promoting growth when needed or cooling down an overheating economy. It is also important to note the distinction between permanent outright purchases and temporary repurchase agreements. While outright purchases are intended for longer-term policy goals, repurchase agreements, often called repos, are used for fine-tuning the daily availability of reserves. In a repo, the central bank buys securities with an agreement to sell them back at a later date, providing short-term liquidity. Conversely, a reverse repo involves selling securities with an agreement to buy them back, which temporarily withdraws liquidity from the system. These subtle but powerful tools are part of the broader monetary policy transmission mechanism, which describes how central bank actions influence the overall economy. Ultimately, a central bank's purchases of government securities are a powerful and often subtle tool they use to fulfill their vital role. By strategically adjusting the financial system's liquidity, they work to ensure stable prices and a healthy economy, supporting the well-being of all citizens through their expert management of monetary conditions.